You built a successful business, pay yourself, and handle your taxes. But somehow, when you walk into a mortgage lender's office, none of it counts. If you've been told your income doesn't qualify because you're self-employed, or if you're just curious how to qualify for a mortgage with unpredictable income, you've come to the right place. I'm Nikita with Collective. We work with thousands of self-employed business owners every day, and this is one of the most common sources of stress we hear about. Today, we'll walk through exactly how mortgage underwriters evaluate self-employment income and what you can do right now to put yourself in the strongest possible position before you apply. One of the most obvious questions you're probably asking yourself, though, is why self-employment income is treated differently in the mortgage world in the first place. Honestly, I felt that way too when I was buying my first house. It's actually not arbitrary, even if it feels that way. When someone has a traditional W-2 job, their income's predictable. An employer verifies it, taxes come out, a lender can look at your pay stubs and know exactly what you're earning every month. It's simple and it's clean. When you're self-employed, your income tells a more complicated story. It might fluctuate month to month. It might look very different from one year to the next, depending on how business went. And because you're responsible for your own taxes, your take-home and your reported income can look very different, depending on how you've structured things. So lenders can't just take your word for it, and the documentation may give them some mixed signals. So they need to see that your income is real, that it's consistent enough to rely on, and that it's likely to continue. That's the lens they're looking through. It's not, is this person successful, but can we reliably predict what this person will earn going forward? Once you understand that, a lot of the mortgage process starts to make more sense. Now, let's talk about what lenders actually look at when you're self-employed, because this is where the process gets pretty specific. And to be clear, you're considered self-employed if you have a 25% or greater ownership interest in a business. The first thing they're going to ask for is 2 years of personal tax returns, your full 1040 with all the schedules and forms. This is their primary window into your income, and they're going to spend a lot of time there. They'll also probably ask for 2 years of business tax returns, depending on how your business is structured. And they're going to look at your year-to-date profit and loss statement if your most recent return is more than a few months old. So what they're trying to do with all of this is build a picture of your qualifying income. Qualifying income is not necessarily what you grossed, and it's not your revenue. It's the number the underwriter arrives at after they've worked through your returns according to their specific guidelines. They'll add some things back in, they'll subtract some other things. Here's one thing that trips a lot of self-employed borrowers up, though. If you've been doing smart tax planning by writing off legitimate business expenses, depreciating equipment, and deducting your home office, your taxable income on paper might look a lot lower than what you actually brought home. That's great for your tax bill, but it can be challenging for a mortgage application. This is the core tension of self-employment and home ownership. And there's no perfect answer to it, but there are ways to navigate it, and we'll get to those. Let's talk about income consistency, though, because this is something lenders care about deeply, regardless of how your business is structured. If you've been self-employed for less than 2 years, most lenders are going to have a hard time counting your income at all. Their general requirement is 2 years of self-employment history before they'll use that income to qualify you. They want to see that this isn't a temporary situation, that your business has staying power, and that your income has some kind of track record. There are exceptions. If you transition from a W-2 job in the same field to self-employment in that same field, some lenders will view that more favorably. If you came out of, say, a 10-year career in marketing and you're now running your own marketing consultancy, that context matters. But in general, the earlier you start thinking about a home purchase, the better. If buying a home is on your horizon in the next 2 to 3 years, the time to get your financial house in order is now, not 6 months before you apply. And if your income fluctuates, which for a lot of solopreneurs it does, lenders typically average your income over 2 years. So if year 1 was lower and year 2 was significantly higher, they'll average those two numbers together. That can work in your favor or against you depending on your trajectory. It's worth understanding before you apply. Now let's talk about business structure, because how you've set up your business does affect how lenders evaluate your income. If you're a sole proprietor, your business income flows directly onto your personal tax return through Schedule C. Lenders will look at your net profit, which is your revenue minus your business expenses, and that's what they work with, not your top line revenue, but your net. So if you brought in 120K last year but had 50K in business expenses, the lender is working with 70K. And if you had a particularly write-off heavy year, that number could be even lower. There are some add backs, like depreciation, for instance. That gets added back in because it reduces your taxable income without actually being cash leaving your bank account. But the baseline is your net profit. And that's the reality sole proprietors need to plan around. If you've structured your business as an LLC, the treatment depends on how the LLC is taxed. A single member LLC that files as a sole proprietor gets treated just like I mentioned before, Schedule C, net profit. An LLC that is elected to be taxed as an S Corp gets treated differently. And that's worth understanding if you've gone that route or are thinking about going that route. For S Corp owners, your income reaches you in two ways. You pay yourself a W-2 salary as an employee of your own company, and you take distributions from the business profits, which show up on a K-1 form. The reason this structure exists is that you only pay self-employment tax on the W-2 portion, not on the distributions, which can mean significant tax savings as your income grows. Here's where the mortgage piece gets interesting. A lot of S Corp owners intentionally keep their W-2 salary on the lower end to maximize those tax savings. And when they do, they go to apply for a mortgage. A lender might look at that W-2 and say, your income is $65K. Obviously, you and I know that that's not the full picture, but not all lenders do. A qualified underwriter knows that for S Corp owners, W-2 wages are only part of the story. They're trained to look at the K-1 distributions as well, and to find a qualifying income number that reflects the owner's total compensation, meaning salary plus their share of the business income. Keep in mind, lenders will want to see a history of actual distributions, not just income showing on the K-1. So the tax strategy that maybe felt like a liability in the mortgage conversation is actually not that big of a problem, like some make it out to be, as long as you're working with a lender who understands how to evaluate it. Which brings me to something really important. Not all lenders are equally equipped to handle self-employment income. It's like one of the most practical things I can tell you. Especially large banks or heavily automated online lenders, they might default to the simplest possible interpretation of your income because their systems aren't built for complexity. They'll look at the W-2 and they'll stop there. They'll see the income fluctuation and they'll get nervous. They'll ask for documentation you weren't expecting and then not know what to do with it. A mortgage broker or lender who specifically works with self-employed borrowers is going to have a completely different experience level here. They've seen complex returns before. They know how to read a Schedule C, handle K-1 income, and work through the add backs. They know what questions to ask and how to present your file to underwriting in the strongest possible way. A couple that come to mind are First National Bank of America and North American Savings Bank, but you'll want to do your own research here and get quotes from multiple lenders. When you're shopping for a lender, ask them directly, how do you handle self-employment income? And ask them, have you worked with borrowers who have similar business structures to mine? Also get clarity on what documentation they'll need beyond your personal tax returns. A lender who knows what they're doing will answer those questions confidently and specifically. That's who you want in your corner. Before we move on to prep, I just want to mention something else that's worth knowing. Bank statement loans. If your tax returns don't tell the full story of what you actually earn because you have a lot of deductions or your business is on the newer side, there are mortgage products specifically designed for self-employed borrowers that work a little bit differently. Bank statement loans qualify you based on your actual cash deposits over a 12 to 24 month period, rather than your reported taxable income. Instead of handing over your tax returns, you hand over bank statements, and the lender uses your deposit history to calculate your income. These aren't shady products, they're legitimate mortgage options, and they're built specifically for people whose financial picture is a bit more complex than a W-2 captures. But there's trade-offs, like everything. You'll typically see a slightly higher interest rate, and you may need a larger down payment. But for the right borrower, these can open a door that may have felt completely closed, especially if you have a strong credit profile. If you've been told you don't qualify based on your tax returns, it's worth asking whether a bank statement loan might be a better path for your situation. Okay, let's talk about what you can actually do to prepare, because this is where you have real control. The first thing is clean, organized books. This sounds basic, I say it all the time, but it matters more than most people realize. When a lender looks at your financials, they're not just looking at numbers. They're making a judgment about how well you run your business. Clean books, organized records, and a clear income story tell a lender that you're a serious operator. Messy finances with commingled personal and business expenses, unexplained income drops, and inconsistent records raise questions that slow everything down or kill the deal completely. The second thing is having an honest conversation with your accountant before you start the mortgage process. The strategies that minimize your tax bill often minimize your qualifying income at the same time. Those two things are in direct tension. There's no magical solution that gets you both maximum tax savings and maximum qualifying income, but you can make intentional choices. If you know you're planning to buy a home in the next year or two, talk to your accountant about what that means for your tax strategy during that window. Sometimes it might make sense to pull back on certain deductions to show stronger income on your returns. It's a trade-off, but it's one you can make deliberately if you plan ahead rather than react after the fact. Third, separate your finances completely if you haven't already. Your personal bank account and business bank account should be completely separate. Similarly, your business expenses should be on the business credit card and your personal expenses should be on the personal credit card. This is good practice regardless on if you're buying a house or not, but lenders really do look for this, and commingled finances create headaches that are entirely avoidable. And fourth, start early. The single biggest advantage you can give yourself in this process is time. If you're not buying for another 2 years, you have 2 years to build a clean income history, get your documentation in order, and have the conversations with your accountant that set you up well. Don't wait until you're trying to buy a house to figure out whether or not you qualify to buy a house. One thing I want to leave you with is that being self-employed does not disqualify you from buying a home. It makes the process more involved and it requires more planning, yes, but it is absolutely doable. People do it every day. The key is understanding what lenders are actually looking at, working with someone who has experience with self-employment income, and giving yourself enough runway to get your financial picture in the strongest possible shape before you apply. At Collective, this is the kind of thing we think about all day, every day, y'all. Helping self-employed business owners build a solid financial foundation with clean books, the right entity structure, payroll and taxes handled, so that when a big moment like buying a home comes around, you're not scrambling. All right, if you found this video helpful, be sure to give it a like and subscribe for more content for self-employed business owners. If you still have questions about buying a house as a self-employed person, drop them in the comments. We're happy to answer them. We'll see y'all next time. Bye.